We are going to continue our discussion in Chapter 1. We've talked about the primary forms of business organization, and we identified the users and uses of accounting information. Today we're going to explain the three principal types of business activity. If you recall back to our first PowerPoint, there are three forms of business organization. There's a sole proprietorship, the partnership, and the corporation. The corporation is what we are focusing on in this class. Users and uses of financial information were the internal users and the external users, and we went over some of the questions that each group would be interested in about the business. Our PowerPoint today is on business activities. All businesses are involved in three types of activity: financing, investing, and operating. Owners obtain cash through financing to start and grow their business. Some of this financing comes from personal savings, and some likely came from outside sources like banks. Owners then invest the cash in equipment to run the business, such as computers or trucks. And once this equipment is in place, they can begin operating activities of making and selling their product. The accounting information system keeps track of the results of each of these business activities. In a corporation, there are two primary sources of outside funds. One is borrowing money. Whenever you borrow money or you owe any amount, it is called a liability. The party to whom amounts are owed are called creditors. And two examples are notes payable and bonds payable. Notes payable are when you borrow money from a bank and you have to pay money back with interest. Bonds payable are borrowing money from people who are then, they're like investors in your company, and over a period of time you will pay them back with interest. Another source is issuing shares of stock for cash. Common stock is a term used to describe the total amount paid in by stockholders for the shares they purchase. Stockholders have no claim to corporate cash until the claims of creditors are satisfied. However, many corporations make payments to stockholders on a regular basis as long as there is sufficient cash to cover required payments to creditors. These payments to stockholders are called dividends. Investing activities. Once the company has raised cash through financing, it will then use that cash in investing activities. Investing activities involve the purchase of the resources a company needs to operate. A growing company purchases many resources, such as computers, delivery trucks, furniture, and buildings. Resources owned by a business are called assets. Cash is one of the most important assets owned. Once a business has the assets it needs, it can begin its operations. Revenue is the amount earned from the sale of products. You could have sales revenue, service revenue, and that would be providing a service, and then interest revenue would be after you have enough money, you may be investing in another company or corporation, and you will be getting interest from them. Inventory are the goods you have available for sale to customers, and then you have accounts receivable. This is the right to receive money from a customer in the future as a result of a sale. If you have a Dillard's credit card, you charge it, and then at the end of the month, you pay them back. That is an example of an accounts receivable. Operating expenses. Expenses are costs of assets consumed or services used. You could have the cost of goods sold. You may have supplies. You have selling expenses, like salaries, marketing, administrative. It could be interest that you have to pay. It could be utilities, rent expense. All those are examples of expenses. Liabilities arise from expenses include accounts payable, and that would be if you borrow, you charge the product that you're going to sell and you pay within a period of time. That's considered an accounts payable. Interest payable would be any interest off loans. Wages payable, you record your wages that way. Sales tax payable, whenever you sell product, you have to send the sales tax to the state. And then, of course, the income tax payable. When all is said and done, you want to have a net income, which is when revenues exceed expenses, or hopefully you won't have a net loss, which is when expenses exceed revenues. Overall, a business has 5 classification of accounts. They are assets, liabilities, common stock, revenue, or expenses. This little activity, we're going to determine what each of these are, what classification of account they are. The cost of renting property. Renting property, we would say, is rent expense, so we would say that is an expense of the business. A truck purchased, the truck is going to be something that we own. If you remember back to our definitions, anything owned is an asset. Notes payable is a liability. Anything that has the word payable after it is going to be a liability. Issuance of ownership shares. Shares should tell you it is common stock. Amount earned from providing a service. Anytime you earn money, it's going to be a revenue. And the last one, amount owed to suppliers. Whenever you owe money, it is a liability. You now have enough information to be able to complete exercises E12 and E13.